Hello everyone. In today's video we will begin covering chapter 2, which is about financial statements, taxes, and cash flows. So the chapter 2 lectures will be broken down into two separate videos. The first video here today will walk through chapter 2 and discuss the conceptual material and an introduction to the quantitative work that will be completed through chapter 2. And then the second portion of the chapter 2 lectures will then have quantitative practice. So that's what you can expect here in the next two videos covering chapter 2. So as I mentioned, this is financial statements, taxes, and cash flows. This is primarily an accounting review for many of you from your accounting prereq, but also cash flows will be additional, and you will be able to identify exactly what we want to focus on these financial statements from the point of view of a financial manager and someone analyzing the financial health of a company. So our learning objectives here today will be to first of all, describe the difference between accounting value or book value and market value. We will then describe the difference between accounting income from cash flows. We will describe the difference between average and marginal tax rates and determine a firm's cash flow from its financial statements. So once again, this chapter is not really focused on the preparation of these different financial statements. Rather, we are looking at what are some of the relevant features and what can we take away from the financial statements that we can analyze. So, financial statements. What is the purpose of these financial statements? So when I say financial statements, I'm talking about the balance sheet and the income statement in particular. So what is the purpose? The purpose is to provide creditors, stakeholders, and owners a foundation for evaluating the financial health of a firm. Well, we know that owners are the shareholders, the owners of the company. Creditors are simply a person or a company to whom money is owed. Well, what is a stakeholder? A stakeholder is someone other than a stockholder or a creditor who potentially has a claim on the cash flows of a firm. So practically anyone who is impacted or impacts or anyone who impacts or is impacted by a company's decisions would be a particular stakeholder. So what are some examples of stakeholders? Employees, management, customers, the general public, regulators, suppliers. These are all different examples of a stakeholder, but these different financial statements, balance sheets and income statements and statements of cash flows, but our focus is on balance sheets and income statements, provide these creditors, stakeholders, and owners a foundation for evaluating the financial health of a firm. So these different entities, these different individuals will be looking at different things based on what their position is, but these different financial statements provide them these means to evaluate these companies. So when companies are creating these financial statements, oftentimes they use what are called the generally accepted accounting principles, or GAAP. These are a common set of standards and procedures by which audited financial statements are prepared. You may have also heard of the standards called IFRS, which are the International Financial Reporting Standards, just another standard that are used by different companies when they are creating or constructing these financial statements. What we will focus on here are the generally accepted accounting standards. So once again, these are rules and standards that they must adhere to when they create these financial statements. What's key about GAAP is that these are guidelines and not rules. So within these different guidelines, there's still room to distort your figures. So as an analyst or as someone looking at these financial statements, it's still important to scrutinize these financial statements. At a minimum, the generally accepted accounting principles will provide these different shareholders or stakeholders some level of consistency as they evaluate the financial statements. So if you remember from chapter 1, we talked about the Sarbanes-Oxley Act, which was put into effect to increase the reliability or to improve the reliability and validity of financial statements. The generally accepted accounting principles are another means of creating some type of consistency. Our discussion here today is we are going to focus on three main principles, and then we'll talk about them throughout today's discussion and how they impact or that we must keep them in mind as we analyze the financial statements. So the first accounting principle that I want to discuss is called the cost principle, which states that transactions are recorded at the cost at which they occurred. So the question you ask yourself is, will these costs actually stay the same, or will these values actually stay the same? Hopefully you realize that they will not. A great example would be when you buy a new car off the lot. So when you go to a car dealer and you buy a new car off the lot, you pay a price. The cost principle would state that you would record that price on your balance sheet as the value of that asset. Yet as soon as you drove that car off the lot, the market value of that car actually changed. So the market value and the book value would be different. due to the cost principle here, the first generally accepted accounting principle that we are discussing. The second principle is called the realization principle, which states that revenue is recognized, or sometimes you will see it listed as realized, hence the name the realization principle. So revenue is recognized when a transaction is complete. So this would this is recognized when a transaction is complete, even though cash may be received earlier or later. So as I mentioned previously with the generally accepted accounting principles, there's still wiggle room within these principles. The realization principle is a great example of this. So the question you ask yourself is, when is a transaction actually considered complete? So is it considered complete when the goods are ordered? Is it considered complete when the goods are shipped? Is it considered complete when your payment is actually received? This realization principle has some wiggle room as to where when companies actually realize that a transaction is complete, but companies do have to disclose when they consider a transaction complete when they submit these financial statements. And so the third principle here is the matching principle. The matching principle states that revenue is matched with the expense incurred to generate that revenue. What's important about this is that when you generate this revenue and you put that on your income statement and you also match the expense, this is not going to actually correspond with the actual cash flows. So for example, let's say you sell a product on credit, so you have a product or you have a value on your accounts receivable, and then the expense for making that product is actually going to be recognized at the same time, even though the cash flows were not actually received. So what's important about the matching principle is that it does not correlate with actual cash flows, and that is something that was mentioned in Chapter 1. It's all about cash flows. It's something that we must keep in mind as we are looking at these financial statements. So the first financial statement that we are going to discuss is the balance sheet. What is the balance sheet? The balance sheet is a financial statement showing a firm's accounting value on a particular date. So the one way that you can look at a balance sheet is that it is a snapshot at a particular time. So a snapshot of the firm at a particular time. So it's like taking a picture of the company and showcasing everything that the company owns, what it owes, and then the value that would be the difference would be the shareholders' equity, what we call a residual value. So on the left-hand side of your balance sheet, you have assets. So as I list here, on the left-hand side, I'll just list the asset side here on a very basic balance sheet. On the left-hand side, we have assets, and assets are listed in order of decreasing liquidity. So what is liquidity? Liquidity is the ease of conversion to cash. So how quickly can I convert an asset to cash? But then there's also a second component of liquidity that is often overlooked, and that second component is without a significant loss in value. So these assets are listed in order of decreasing liquidity, and assets are broken down into two categories. Current assets, which have a lifespan of less than 1 year, so you're looking at values like accounts receivable, cash, and inventory. And then you also have your fixed assets, which have a lifespan of greater than 1 year, so you're looking at land, goodwill, property, plant, and equipment. So these are the left-hand side of your balance sheet, current assets and fixed assets. And then when you're discussing fixed assets, you have two different types of fixed assets. You have tangible fixed assets, so tangible just means you can physically touch it, so like a truck or a computer would be a tangible fixed asset. And then you also have intangible fixed assets. Intangible fixed assets are those types of assets that you can't physically touch. So for example, you have patents, trademarks, copyrights. Those are examples of intangible assets. So these on the left-hand side of your balance sheet are what the company owns. On the right-hand side then, you have your liabilities. Liabilities are what the company owes. So once again, these are listed on the right-hand side, and these are listed in ascending order of when due to be paid. Liabilities are also broken down into two different time frames. You have your current liabilities, which are those liabilities that must be paid within 1 year, and then you have your long-term liabilities, which oftentimes you'll just see listed as long-term debt. So that's what liabilities are, your debt obligations. So this long-term liability is debt that is not coming due in the coming year. So for example, this would be like your bonds, which we'll discuss in a later chapter. But these are your long-term creditors. Basically, liabilities are showcasing how you fund your assets in the form of debt. So we talked about debt versus equity in Chapter 1, your capital structure. This liability portion showcases the debt portion of your capital structure used to purchase or to fund those asset purchases. So then you have this account, which is stockholders' equity, which is referred to as a residual value. It's called the residual value because the thought is if a company took all of these assets and converted them to cash, paid off all of their liabilities, what remains would belong to the shareholders. So this is your stockholders' equity. So stockholders' equity accounts are simply accounts such as common stock, preferred stock. You have your retained earnings. These are all examples of owner's equity accounts. When you're looking at the balance sheet, the first, I guess, kind of equation that we want to cover is what is called the balance sheet identity. And identity is something that is always true. If you remember about the balance sheet must always balance. The balance sheet identity must always equal one. The cash flow from assets must always equal the cash flow. Or sorry, I'm getting a step ahead of myself. The balance sheet identity is something that always must be true. The balance sheet must always balance. So this left-hand side, your total assets, must always equal your total liabilities plus your total stockholders' equity. Okay, so once again, owner's equity is sometimes referred to as a residual value with that thought process of if a company were to take all of their assets, convert them to cash, and pay off the liabilities, what remains would belong to the shareholders. And so this is the first thing that we discuss is the balance sheet identity, where total assets equals total liabilities and stockholders' equity. This is always true. Balance sheet always must balance. Now, first thing that I guess the first equation that we covered was the balance sheet identity. The second equation that we're going to cover is what is called net working capital. If you think back to Chapter 1, we said that one of the 3 decisions of the financial manager is working capital management decisions, and that's focusing on your current assets and current liabilities. Net working capital is simply the difference between those two values. So net working capital is the difference between current assets and current liabilities. Typically, this number is usually positive for a healthy firm. So when you're looking at net working capital, you think to yourself, is the cash the cash that is going to become available within the next year, so current assets or those assets that will be converted to cash in less than 1 year, the cash that will become available over the next 12 months exceeds the cash or the cash that must be paid your current liabilities over that same time frame. Okay, so that's what net working capital is. It is positive when the cash that will be received over the next 12 months exceeds the cash that will be paid out. As I mentioned, for healthy firms, you oftentimes would have a positive net working capital. Now, from a financial manager's point of view or from an investor's point of view, when you are examining the balance sheet, there are 3 particularly important things to keep in mind. First is liquidity. So we already discussed the characteristics of liquidity in on the previous slide. So the ease of conversion to cash without a loss of value. Liquid firms are less likely to experience financial distress, so liquidity is valuable. However, liquid assets typically earn a lower return. So your current assets, your short-term assets, those more liquid assets, typically earn a lower return than your fixed assets. Your fixed assets, your capital budgeting decisions, if you think back to Chapter 1, capital budgeting is your long-term investments, those are your fixed assets investments. Those are the ones that drive most of your revenue. So liquid assets typically earn a lower return. There's a trade-off as liquid assets are generally less profitable, but liquid firms also are less likely to experience financial distress because you're able to meet your obligations as they come due. Another thing to keep in mind when looking at the balance sheet is the amount of debt versus equity. This is your capital structure. So once again, we've introduced a new term of capital structure, but that's really just how a company is funding their assets. Are you funding it using debt or are you funding it using equity? Another term that we're going to introduce is the term called leverage. So financial leverage is the use of debt in a firm's capital structure. They say that the more leveraged a company is, the more debt that the company uses. So the more debt that the firm has as a percentage of its total assets, the greater their degree of financial leverage. Now, leverage is twofold. Leverage magnifies gains, but it also magnifies losses. So the more debt that you utilize, the more funds that you have available, and you're able to deduct those interest payments on your income statement before you pay taxes. The potential reward is larger by using debt, but on the other side of the coin, you have to keep in mind that you must pay those interest obligations on that debt. So those are fixed payments that you have to make regardless of what your revenues or your cash flows may be. So you have magnified losses as well. So with the use of debt, it's important to realize that debt or leverage actually magnifies gains, but it also magnifies losses as well. The third thing to keep in mind is market value versus book value. So what is the difference between market value and book value? Well, the balance sheet provides your book value based on the cost principle, if you remember, and market value is the price at which the assets, liabilities, or equity can actually be bought or sold. Okay, so we are always concerned with market values. Book values are values that are listed on our books due to the cost principle. Now, some of these values may be close in value between book value and market value, and some of them may be substantially different. Your current assets are typically close in terms of market value and book value because of their short-term nature, whereas long-term assets can fluctuate drastically at times. So as I mentioned, market value and book value are often very different, and that's because of the cost principle. And which would be more important to the decision-making process? One thing that's important to keep in mind and mention now is that we are always concerned with market values. Okay, we are always concerned with market values. That's why when we say to max the goal, thinking back to chapter 1 here, when we said the goal of financial management or the goal of any company is to maximize shareholders' wealth, that does not mean maximize the stockholders' equity portion of the balance sheet. When we say maximize shareholders' wealth, we are maximizing the market value of the shareholders' wealth. How do we view the market value of shareholders' wealth? We see that in their stock price. So that's why we say to maximize shareholders' wealth, we are maximizing the market value of the stock, not necessarily the stockholders' equity balance here on the balance sheet. So that, wrapping things up on the balance sheet, here is a very basic balance sheet for a hypothetical company called the U.S. Corporation. Here we can see on the left-hand side we have our assets broken down into current, less than 1 year, fixed, which is greater than 1 year. On the right-hand side, we have how they fund those assets, liabilities or owner's equity. Once again, we have short-term liabilities, your current liabilities. We have your long-term liabilities, your long-term debt, and the difference being the owner's equity. Once again, the balance sheet identity holds true. The total assets must equal the total of liabilities plus stockholders' equity, and this is true for both years. So the balance sheet identity does indeed hold true. Again, just breaking down the balance sheet, I guess the one addition here would be the definition of net working capital, which is the difference between current assets and current liabilities. As you can see here on this slide, this company would have a positive net working capital because their current assets exceed their current liabilities. So they are able to meet or pay their short-term obligations or cover their short-term obligations with their most liquid assets, their current assets. And once again, this shareholders' wealth is called a residual value because the thought process is if the company were to take all of these assets, convert them to cash, pay off all of your liabilities, the difference, what remains, belongs to the shareholders. So the next statement that we will be analyzing is the income statement. So we said that the balance sheet is a snapshot or a picture of a company at a particular point in time. It's almost immediately outdated because the values change so frequently. Where, on the other hand, an income statement tells a story. So the income statement is a financial statement that summarizes a firm's performance over some period of time. You could think of it as a video, or it tells a story over some period of time. It could be a specific period, or for a quarter, or for a year. So the balance sheet is a picture. The income statement is more like a video. Generally, what you're going to do is report revenues or sales first, and then you would deduct any expenses for the period. Can you think back to earlier in today's lecture of the principle that says you show revenue when it accrues? Well, that would be the realization principle or the recognition principle. And then what is the principle that says you match the expenses required to generate the revenue? Well, that would be the matching principle. Once again, this does not necessarily correlate with cash flow, so it is something that we must keep in mind, that those two principles in particular play a much more significant role here when you're creating the income statement. The last item on the income statement is the last item on your income statement is net income, or the so-called bottom line. Sometimes you will see net income represented or showcased on a per share basis, which would be simply earnings per share, which is net income divided by shares outstanding. So here's a very basic income statement once again for this U.S. corporation. You can see that they start off with the revenues, or their net sales. They take out their cost of goods sold. You have a non-cash expense of depreciation. We'll talk about that more. You work your way down. You see your earnings before interest and taxes, oftentimes referred to as EBIT. You deduct your interest expense. That's where your leverage comes into play. The amount of debt that you're using, you get to deduct that interest expense before you pay taxes. You get your taxable income, which is sometimes referred to as your EBT. You pay taxes and you get your net income. And a company then has two options with their net income. They can either pay it out in the form of dividends to their shareholders, or they can reinvest it into the company in the form of retained earnings to grow what is called organically. So reinvesting or plowing back the funds into the company to grow in that manner. So the income statement, when you're looking at the income statement, the financial manager or someone analyzing these this statement needs to keep three things in mind. The first is the generally accepted accounting principles. So what do I mean by keeping that in mind? That's how it's constructed. Well, an income statement that uses GAAP will show revenue when it accrues due to the realization principle, and it's often going to showcase your expenses when that revenue is recognized due to the matching principle. So oftentimes it's not the same as collection, so it's not correlating with the actual cash flow. So for example, let's say you manufacture and sell a product on credit. You recognize that revenue at that time and the costs that are associated with the sale of that product, although you've actually had no cash inflow since you sold it on credit. And on the other side of the coin, the outflows may have occurred at different times as well. So due to the generally accepted accounting principles, the values listed on the income statement do not correlate with cash flows. We'll try to make that conversion here later on in today's discussion when we talk more about cash flows. The second thing that the financial manager needs to keep in mind is cash versus non-cash items. So you start off with your sales and you start to deduct your expenses. Some of those expenses that are taken out of your revenues do not directly affect cash flows. So you deduct them as an expense, yet no cash flows are actually leaving the company. The biggest examples of those would be depreciation and amortization. Depreciation is the deduction of an asset's cost over the lifespan of that asset. You can depreciate it either straight line or accelerated. You can use one for tax purposes, one for public purposes, but you have this non-cash expense deducted on your income statement. And then amortization is really kind of the same process, except it deals with intangible assets. So this is marked on the income statement. These two items are marked on the income statement as an expense, but cash isn't actually leaving the firm, and we are most concerned about the actual timing of cash inflows and outflows. And then the third one then, going right along with that, would be the timing and the costs. Looking at this income statement, are these costs fixed costs or variable costs? With the income statement and the generally accepted accounting principles, it is very difficult to look at an income statement and identify for certain which costs are fixed costs, which costs are variable costs. And so from a financial manager's point of view, which costs can we actually decrease or which costs can we actually better manage when you're looking at this income statement. So that was the income statement. We move forward into how can I find these financial statements. So all publicly traded companies must file regular reports with the SEC, the Securities and Exchange Commission. And these reports are usually filed electronically and be searched at the SEC public site called EDGAR. EDGAR is short for the Electronic Data Gathering, Analysis, and Retrieval System. You could simply go to Google and type in EDGAR, and your first hit's going to be at sec.gov, and it's going to be this system. So what different items or what different statements must companies submit with the SEC? First of all, they need to submit what is called a 10K. So all publicly traded companies are required by law to file this 10K. If you have any interest in investing in individual stock in individual company stock, 10Ks are something that you must familiarize yourself with. There is a lot of information within these 10Ks, and if you want to better understand a company and its operations, its risks, and all about a particular company, analyzing a 10K is something that you must become familiar with. So if you have not yet looked at a 10K, I highly recommend going to Edgar and just looking at a 10K for your favorite company. It could be Apple, it could be Nike, but any particular company. Open up the 10K and get familiarized with what is included in these different documents. So what is included in a Form 10K? It is a comprehensive overview of business and financial condition, including audited financial statements. So due to the Sarbanes-Oxley Act discussed in Chapter 1, these are audited by an external auditor. It will include the fourth quarter and full year results. This 10K is different from the annual report to shareholders. So this will include more disclosures, but does not include the letter to shareholders, any images of products or many graphs or additional narratives. So it's not quite as visually appealing. It gets right down to the actual details of that particular company's operations. And you may have seen a 10K wrap before, which has replaced traditional annual reports for many companies over the last 10 years. So within this 10K, there's a lot of information. Different parts may include an explanation of the company's operations. So how does it make its money? What market does it currently operate? It's also going to disclose any risks, so including any current lawsuits. It's going to include those audited financial statements that were listed previously. So it will allow you to see what is going on with that company's finances. It's going to show you what the company's accounting policies are. So how does it operate, or how does it deal with, for example, the realization principle? When does it state that a revenue or that a transaction is complete? Or what is the different warranties that they have for their products? These are different things that would be included in the 10K. You'll also see the CEO and the CFO letters where they validate the correctness of the statements. So once again, the CFO and the CEO must sign off on their financial statements due to the Sarbanes-Oxley Act. You will see this statement within the 10K. You'll also see things like executive compensation within the 10K. But as you can kind of see with my rambling on here, there is a lot of information that is included within the 10K. I highly recommend kind of jumping in and just looking through and analyzing a company of your choice. In addition to the 10K, companies must also submit a 10Q, which is simply a quarterly report. So they are filed for Q1, Q2, and Q3. So these are continuing view of financial condition during the year, including unaudited financial statements. So in these 10Qs, oftentimes the financial statements are unaudited as opposed to the audited financial statements of the 10K. Just something to keep in mind. Another form that companies must submit is a Form 8K. So these are unscheduled material events that are important to shareholders, so they are filed as needed. Different events could be the CFO leaving, maybe the SEC is conducting an investigation, maybe there's a new business deal, maybe they're planning on shutting down a plant, maybe there's going to be layoffs, maybe they're filing for bankruptcy. So anytime you have these material events, a company must submit a Form 8K. So as I've kind of mentioned with how much information is included in these different documents, why are these important? These are just pure information about a company without any, and they are unblemished by any brokerage analysis. So very important that you kind of just dive in and familiarize yourself with these. So as you can see here at the bottom of the slide, what are my retrieval options? You could go to the company website and click on investors, or as I mentioned, go to sec.gov, look at the Edgar database, or just type in Edgar, which once again is the Electronic Data Gathering Analysis and Retrieval System, and look up some companies' 10Ks. Now, there's a lot of different sections to a Form 10K. What I have here in the PowerPoint are the different sections and what's included. I'm not going to go through in detail on all the different items. Just jump in and kind of familiarize yourself with them. In item 1, you have a detailed business description. So what is the background? What is their strategy? What is their organization? What are their products, their markets, distribution, competition? What is their R&D? Those are all different things that will be included in item 1. In item 1A, you have different risk factors. So why apply? What type of risk do they face in Europe, or what types of risk do they face internationally, or what's going to impact their ability to compete? Maybe ingredient costs are increasing, whatever the company's business may be. I'm just going through different companies in my head. But how can they remain competitive? What are some other risks that are present? These are all listed in item 1A in the 10K. In item 2, list of properties that will show you where the company is located, what are their different facilities. Item 5, you have stock information. Item 6, you have selected financial data over the past 5 years. So selected financial data would be like your main accounts, so sales, net income, earnings per share, total assets, total liabilities, total stockholders' equity. This type of information is included in item 6. Item 7 would be overview and highlights for that particular year. Item 8 would be your total financial statements. So those are your audited financial statements. So as you can see, though, there's a lot of different information. There's your executive compensation in item 11. There's just a lot of information here in the 10K that is valuable to look into. With the 10Q, you also have this other information here. I'm going to save you the time and not go through each item. You guys can read. Most importantly, the best way to really understand what's in these different documents is to just dive in and familiarize yourself with them. Next, we move into taxes. Taxes are a very important part of business. It's important to understand how corporations are taxed. So thinking back to chapter 1, when we talked about the different forms of business structure, we talked about partnerships, sole proprietorships, and corporations. Think to yourself, how are partnerships and proprietorships taxed? Well, they are taxed as pass-through entities, so owners are taxed at the personal level on their income. Now, this personal tax is taxed on what is called a progressive tax schedule. And when you have a progressive tax schedule, there are two different types of rates that you must understand: the average tax rate and the marginal tax rate. The definitions here for the average tax rate, those are the total taxes paid divided by total taxable income. The marginal tax rate is the amount of tax payable on the next dollar earned. This may be a little confusing right now. On the next slide, I have this progressive tax schedule, and I can showcase what the difference is. But make sure you know these two definitions. It is important. And the reason why I'm kind of stumbling with my words here is because there was a change in 2017 due to the Tax Cuts and Jobs Act, which actually instituted a flat tax rate for corporations of 21%. So hypothetically, with the Tax Cuts and Jobs Act of 2017, the average tax rate and the marginal tax rate for corporations would be 21%. There's no progressive tax schedule where different parts of your taxable income have different tax rates. But I do want to touch up on this average and marginal tax rates because your individual taxes operate on in this manner. So it is important for your own personal finances to understand how you pay taxes. You are taxed on a progressive tax schedule. What is a progressive tax schedule? This is what a progressive tax schedule is. What it showcases is different parts of your taxable income are taxed at different interest rates or different tax rates. So for example, for the first $50,000 of your taxable income, that income is taxed using a 15% tax rate. Then for the next $25,000, so from $50,000 to $75,000, that part of your taxable income is taxed at a 25% tax rate, and then you can work your way through the taxable income and see what the different tax rates are for the different portions of your taxable income. Let's jump into an example so you have a better understanding. Let's say a corporation, so this is pre-2017, before the Tax Act or the flat tax rate of 21% was implemented. So suppose a corporation has a taxable income of $150,000. So if we go back to the schedule, their taxable income here is in this fourth bracket, $150,000. So the marginal tax rate, by definition, is the amount of tax payable on the next dollar earned. So if they have taxable income of $150,000, if they made one extra dollar, so $150,000 and $1, what tax rate would be applied? 39%. So that is what is called a marginal tax rate. Their marginal tax rate is simply 39%. To calculate the average tax rate, you figure out what the total amount of taxes paid is and divide it by this taxable income. So what is their total amount of taxes paid? Well, for the first $50,000 of their taxable income, they're going to be taxed at 50%. So for the first $50,000 of their taxable income, they're taxed at a tax rate of 50%. So you take 50,000, the width of that bracket, 50,000 times 15%, their tax liability for their first 50,000 is 7,500. Then for the second portion of their taxable income, for the second bracket, which is from 50,000 up to 75,000, they're taxed at 25%. So I know I'm going back and forth between slides, but if you see this second part of the bracket, which I kind of already have circled here, for this portion of the bracket between 50,000 and 75,000, you're going to be taxed at a 25% tax rate. So you figure out the width of that bracket, and you multiply it by the tax rate for that particular step, for that particular level of your taxable income. So 25% times the width of this bracket, which is 25,000. Their tax liability for that second portion of your taxable income is 6,250. If you continue on, you can see that you will be taxed at 34% for the next 25,000, which gives you a tax liability of 8,500. And then the last part, the taxable income was 150,000. You subtract the bottom of the bracket, which is 100,000, multiply it by the tax rate for that bracket, which is 39%, and you end up getting a tax liability for the fourth bracket of 19,500. So these are your tax liabilities for each bracket, or each portion of your taxable income. You sum those together, and your total tax liability then is 41,750. To calculate your average tax rate, you take your tax liability and you divide it by your taxable income, and you'll get an average tax rate of 27.8%. So your average tax rate is 27.8%, but your marginal tax rate is 39%, which would say that if I earned $1 extra, so instead of 150,000, if I had 150,001 dollars, what rate would be applied to that $1 extra? It would be the rate. It would be that tax rate within that particular bracket. The only exclusion would be if that extra dollar would put you into a different tax bracket. So let's say it was 7,500 was, or sorry, let's say 50,000 was your taxable income, and you earned $1 extra, it put you into the next bracket, which would then be taxed at the 25%. But for our purposes, the marginal tax rate is simply the tax rate applied to the next dollar earned. Something to keep in mind for your own personal taxes. You oftentimes hear someone say, yeah, man, I took on this extra job, put me in a different tax bracket. This is what they're talking about, this progressive tax schedule. So this is extra material to understand how your own personal taxes actually operate. Just keep in mind for corporations, now they have a flat tax rate of 21%. Now this is just federal tax, so there are differences for state tax and local taxes. And this is all a simplified version of the tax schedule, because obviously there's many loopholes and deductions that we've left out, but for the main purpose here of understanding how corporations are taxed, there's a flat tax rate of 21%. So we wrap up chapter 2 here with a very, very important concept, which is the concept of cash flow. So cash flow is one of the most important pieces of information that a financial manager can derive from financial statements. Remember that in Chapter 1, when I said maximize shareholders' wealth, I talked about maximizing cash flows. When analysts analyze a company and provide a value, what they do is they project or predict future cash flows and discount them back to a present value. This is what they're doing. So we're trying to figure out how are these cash flows actually calculated. The statement of cash flows, you may have heard that, does not actually provide us with this same information that we're looking for here. So the statement of cash flows, actually talks about or helps explain the changes from one balance sheet to the next. Our focus here is what is the number of dollars that came in and what are the number of dollars that that went out. So that's what we're looking for when we're talking about cash flows, is what are the number of dollars that came in and what are the number of dollars that went out, and also where did those dollars go. So we will look at how cash is generated from utilizing assets, your investments, and then how it is paid to those that finance the purchase of those assets. And just like we talked about earlier, we talked about the balance sheet identity, something that's always true. With cash flows, there is something that's always true, and it's called the cash flow identity. The cash flow identity simply says that cash flow from assets is equal to cash flow to creditors plus cash flow to stockholders. So your asset investment is generating cash flows. How are you distributing those cash flows? Are you paying them off to the creditors, or are you paying out to the form of stockholders? Once again, this is an identity, something that is always true, so this will always balance out. Please keep that in mind. So first, let's focus on cash flow from assets. Cash flow from assets is also called free cash flow. It is called free cash flow because the company is free to distribute it to creditors or to their shareholders. And cash flow from assets involves three components. The first is operating cash flow. So operating cash flow is simply cash flow that results from the firm's day-to-day activities of producing and selling. Then you have capital spending. Capital spending refers to your net spending on fixed assets. So the purchases of your fixed assets minus the selling of any fixed assets. And then lastly, you have changes in net working capital. Remember that net working capital is current assets minus current liabilities, discussed earlier in this video. And this represents your net increase or decrease in current assets over current liabilities. So essentially, what types of cash flows are your assets bringing in? And then what type of cash flows are your assets bringing in? And then what types of cash flows occurred from the spending or selling of those different assets that help generate those cash flows. So first, what is the equation? Well, your cash flow from assets, CFFA, would be an acronym for it, is cash flow from operations, and then you deduct net capital spending, and then you deduct changes in net working capital. We have specific equations for each of these three portions of your cash flow from assets. So first, operating cash flow. So operating cash flow comes from your income statement. What we want to do is calculate revenues minus costs, but we do not want to include any non-cash expenses. So what did we say non-cash expenses were? Depreciation. So what we will do is we will take our EBIT, which is your operating income, so earnings before interest and taxes. So this is simply sales minus costs minus depreciation. We add back in the non-cash expense of depreciation, and then we subtract taxes. So we do not want to include depreciation because it's not a cash outflow. It's an expense, but no cash is actually leaving the company. And then we also don't want to include interest, your I there in EBIT, since that is a financing expense. Your interest expense, what you pay on your debt obligations, is something that will go into calculating our discount rate, something that we'll cover later on. So don't worry if you're confused about this discount rate discussion. So this is essentially this operating cash flow, or OCF, is simply how much cash flow occurred strictly from your operations. So are the firm's cash inflows from its business operations sufficient to cover its everyday cash outflows? So a negative operating cash flow is a sign of trouble for a company. So your cash flow from your operations is actually negative. You're not able to cover your everyday cash outflows. A negative operating cash flow is a sign of trouble. Second portion of this cash flow from assets was capital spending. So this is taken from your balance sheet and your income statement, and this focuses on your fixed assets. So what we do is we take our ending net fixed asset balance and we subtract our beginning net fixed assets balance. And since on the balance sheet you depreciate your fixed assets each year, we're going to add back in that depreciation expense from our income statement. Okay, so net capital spending is simply money spent on your fixed assets minus any money received from the sale of fixed assets. So ask yourself this question: could capital spending be negative? So could this actually be negative? Certainly. All this means is that the firm actually sold off more assets than what it purchased. So the net simply refers to the purchases of fixed assets net of any sales of fixed assets. Third equation is your change in net working capital taken from your balance sheet, which is your ending net working capital minus your beginning net working capital. Keep in mind that net working capital is current assets minus current liabilities. So you would have to calculate your ending net working capital for the period that you're analyzing minus your beginning net working capital. So as we're calculating these cash flows, these are cash flows over a period of time, okay? So please keep that in mind, that we're calculating the cash flows typically from one year to the next. But this is how you would calculate cash flow from assets. Calculate operating cash flow, subtract capital spending, and then subtract change in net working capital. Now, when you are looking at cash flow from assets, which I said is also called free cash flow, it is not unusual for a growing corporation to have a negative overall cash flow from assets. All that means is that the company is spending more on their assets than what their current asset base is actually generating. So it could be that they're actually growing by investing in themselves, investing in additional assets than what their current asset base was actually generating. Another way that you could think about this is that based on your cash flow identity, which says that cash flow from assets equals cash flow to liabilities plus cash flow to stock or the creditors. Cash flow to creditors plus cash flow to stockholders. All this means is that if it's negative, they are actually paying more. They are actually borrowing more than what they're actually paying out. So they raise more money by borrowing and selling than what it actually paid out over that year. That would signify the negative cash flow from assets. Now looking at the right-hand side of our cash flow identity, cash flow to creditors. So this is taken from your balance sheet and your income statement. It is interest paid, since your creditors is your debt obligations. What interest have you paid minus any net new borrowing, so what you brought in. Sometimes this is called cash flow to bondholders, since bondholders are typically your long-term debt obligations. And then we also have cash flow to stockholders, then the final portion of the cash flow identity, which is taken from the balance sheet and the income statement, and it is dividends paid minus net new equity raised. So to get the net new equity raised, we look at common stock and paid in surplus. And what's important is, and I hope you write this in your notes, do not include changes to retained earnings, as that is not raising capital in equity markets. So what's important is it is net new equity raised. So what did I raise in equity markets? Retained earnings is growing organically. You're not actually raising any funds from these equity markets. So we'll do an example in part 2 of this lecture, but do not include changes to retained earnings in your cash flow to stockholders. It is simply the dividends paid from your income statement minus your net new equity raised. So you're going to be looking at common stock in particular and paid in surplus values from one year to the next to identify what new equity was raised. So that wraps up the conceptual portion of Chapter 2 and what we'll be covering then in the quantitative portion of Chapter 2. Hopefully you were able to receive a little bit of a refresher, and some of this isn't completely new for you from your accounting prereq, but then we can kind of further elaborate on, from a financial manager's point of view or from a stakeholder or creditor's point of view, what you can take from these different financial statements. And so then in part 2 of this lecture, what we will do is work through some quantitative problems that will be very similar to those problems that you will see on your homework and exam. So thank you for watching. I hope you're all having a great day or evening, whatever time it may be as you're seeing this. If you have any questions, don't hesitate to reach out, and I'll talk to you all soon. Thanks.